Understanding how to read stock charts is a crucial skill for any investor looking to make smarter decisions in the market. Stock charts visually represent the price movements and trading volumes of a stock over time, revealing trends, patterns, and key signals that can guide your buying or selling choices. In this quick guide, we'll break down the basics of stock charts, like candlesticks, support and resistance levels, and moving averages, so you can confidently interpret the data and improve your investing strategy. Today we will talk about how to read stock charts for better investing. So before we start, make sure to hit the like button and subscribe to my channel. 1. Understanding the basics of stock charts. Stock charts are graphical representations of a stock's price movements over time. They help investors visualize trends, identify patterns, and make informed decisions about buying or selling. The most common types of stock charts are line charts, bar charts, and candlestick charts. Line charts plot the closing prices over a set period, providing a simplified view of stock performance. Bar charts display opening, closing, high, and low prices, offering a more detailed snapshot. Candlestick charts, originating from Japanese rice traders, are now the most popular among traders because they visually show the relationship between opening and closing prices with color-coded bars. Understanding these chart types is the first step in learning to read stock charts effectively. Each chart reflects data points such as price, volume, and timeframes that can be customized from minutes to years, depending on the investor's strategy. Mastery of these basics allows investors to gauge market sentiment and potential future price movements. 2. Reading price movements and trends. The core function of a stock chart is to depict price movements, which investors use to identify trends. A trend is a general direction in which a stock's price is moving. There are 3 types of trends: uptrends, higher highs and higher lows; downtrends, lower highs and lower lows; and sideways trends, prices moving within a range. Recognizing these trends early can help investors position themselves advantageously. Trend lines, which are straight lines drawn on charts connecting consecutive lows in an uptrend or highs in a downtrend, assist in visually confirming trends. Additionally, support and resistance levels are key price points where a stock tends to stop falling or rising, respectively. These levels can signal potential reversals or breakouts. Volume, the number of shares traded, complements price trends by confirming their strength. For example, an uptrend accompanied by increasing volume signals strong buying interest. Reading these price patterns and volume dynamics is crucial for better timing investment entries and exits. 3. The role of technical indicators beyond raw price and volume data. Technical indicators provide deeper insights into stock chart analysis. Indicators are mathematical calculations based on historical price, volume, or open interest data, designed to forecast future price behavior. Commonly used indicators include moving averages, relative strength index, RSI, moving average convergence divergence, MACD, Bollinger Bands, and stochastic oscillators. Moving averages smooth out price data to help identify trends by averaging past prices over a specific period, a 50-day or 200-day moving average. RSI measures the speed and change of price movements to indicate overbought or oversold conditions, typically using a 0-100 scale. MACD shows momentum by comparing short-term and long-term moving averages, signaling potential buy or sell points. Bollinger Bands plot price volatility around a moving average, indicating possible price breakouts. By combining these indicators with chart patterns, investors can develop strategies to enhance decision-making and reduce emotional bias. 4. Decoding candlestick patterns. Candlestick charts are packed with information through their unique shapes and colors, which can indicate market psychology. Each candlestick consists of a body, difference between open and close price, and shadows, highs and lows during the period. Green or white candlesticks show bullish movement, price closing higher than opening, while red or black indicate bearish movement, price closing lower than opening. Investors use specific candlestick patterns to predict market direction. For example, a doji signals indecision when open and close prices are nearly equal. Hammer and shooting star patterns often suggest potential reversals when appearing at trend extremes. Complex patterns like engulfing, morning star, and evening star combine multiple candlesticks to indicate stronger signals. 5. Volume analysis for confirmation. Volume represents the total shares traded in a given period and is critical in validating price movements. High volume often indicates strong investor interest and can confirm the sustainability of a price trend. For instance, a price breakout above resistance, accompanied by high volume, is more likely to be genuine than one with low volume. Conversely, price moves on low volume might signal a false breakout or a weak trend. Volume indicators such as on-balance volume (OBV) or volume-weighted average price (VWAP) help investors analyze volume trends in relation to price. OBV accumulates volume based on price direction to show buying and selling pressure, while VWAP gives the average price weighted by volume, often used by institutional traders. 6. Timeframes and their importance. Stock charts can be viewed over various timeframes, ranging from intraday, minutes or hours, to daily, weekly, or monthly charts. Each time frame provides different insights depending on the investor's style and goals. Day traders often focus on 1 to 15-minute charts to capitalize on short-term price fluctuations, while swing traders may prefer daily or weekly charts to identify medium-term trends. Long-term investors generally analyze monthly or weekly charts to focus on broad market movements and avoid noise from short-term volatility. Understanding how to read charts across different timeframes enables investors to align their strategies with their risk tolerance and investment horizon. 7. Common chart patterns and their implications. Chart patterns are shapes formed by price movements that often predict future price directions. These patterns fall into two categories: continuation patterns and reversal patterns. Continuation patterns such as flags, pennants, and rectangles suggest that the existing trend will likely continue after a brief pause. Reversal patterns like head and shoulders, double tops, and double bottoms indicate that the current trend may be ending and a new trend could begin. For example, a head and shoulders pattern, characterized by three peaks with the middle peak highest, signals a potential bearish reversal. Conversely, a double bottom looks like a W and indicates a bullish reversal. By recognizing these patterns early, investors can anticipate market movements and adjust their positions accordingly, often setting stop-loss orders or profit targets based on the pattern's implications. 8. Integrating fundamental analysis and stock charts. While technical analysis via stock charts focuses on price action and market behavior, integrating fundamental analysis can enhance investment decisions. Fundamental analysis evaluates a company's financial health, earnings, industry position, and macroeconomic factors. Chart patterns and indicators often reflect the underlying fundamentals but can also be influenced by short-term market sentiment or news. Combining both approaches helps investors avoid over-reliance on price movements alone. For example, a strong uptrend on the charts, supported by solid earnings reports and positive industry trends, offers a more reliable investment signal. Conversely, if charts suggest a buying opportunity but fundamentals are weak, caution may be warranted. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.